Hi everyone, welcome to Expert Chat hosted by OnFrontiers, the accelerated learning platform for sharing ideas, information and knowledge around developing countries across the world. I'm today in London's Covent Garden at the offices of Jerome Booth, who many people will know as the co-founder of Ashmore, one of the UK's most successful emerging market investment firms with billions of dollars under management. Since co-founding Ashmore, Jerome's been doing an incredible amount of other things, one of which is writing an excellent book called Emerging Markets in an Upside Down World, and he's even got the globe here to represent that image of how investment philosophy needs to be turned on its head in terms of risk assessment. Since then, he's also founded a company called New Sparta, which has various different components to it. It's a big investor in things like energy, in high growth technology, media, telecoms. So Jerome, thanks very much for joining OnFrontiers Expert Chat. I want to begin by looking at how you approach emerging market risk. And I know risk is a key word for you, but you know, and what I mean is that at Ashmore, you saw a lot of the key events that were going to happen. You know, we used to talk, you know, almost a decade ago when Argentina was going into default. That was one that you called, which, you know, in retrospect seems easier than it was at the time.
Well, I think it was quite easy at the time, actually. and perversely, the more dramatic an event, the easier it often is in terms of, you know, big macro calls, because when you're in crisis, the decision maker, the president or finance minister, whoever it is, typically has very limited choice and a very limited time in which to make that choice. And so particularly the time frame becomes more predictable. If you add, particularly in the 90s and the early noughties, the very important role of Washington institutions, particularly the IMF, and creditors, you could see the incentive structure very clearly, and you knew that certain decisions had to be made. And so it's often the way that you could put yourself, if you like, in the shoes of the decision maker and try and work out what he or she was thinking, and it was often, you know, pretty straightforward. Okay,
so put your shoes, for example, taking a current example, your President Maduro in Venezuela. You know, the economy is telling you you should default. The politics are really telling you you should default because people are desperate there. How do you approach that from the rigor of so many different moving parts? What's the approach? What's the
Venezuela,
discipline?
Of course, is, you know, I mean, Maduro is not the sort of person who's going to change course, and that's perfectly obvious to everybody. And I think it's a question of, you know, will he or won't he break? And that's what we're looking at. So it's a rather different, much more political situation than a macroeconomic or balance payments crisis. But I've seen people recently, you know, ask, well, how it could be. I think it was one of the questions that was sent in. You know, how it is that, you know, they haven't defaulted, and it's very glib. But I think you should think about the sort of two of the traditional defaulters in Latin America rather differently. And I'm you know, maybe painting an unfair brush on Argentina by including this, but Argentinians have always been very sophisticated and very persuasive. They're often educated, you know, at top schools, and they understand the mind of the investor and the international visitor very, very well, and they are extremely good. So if you're playing a game of poker, they're equivalent to some very, very good poker players. Unfortunately, they've got a 3, a 9, and you know, a 6 and a 7. And you know, when they have to put their cards down, that's it. There's nothing there.
Okay, so
in Venezuela, on the other hand, they are drunk, and they look drunk. But their hand is full of aces and kings, and all you have to do is wake them up, get them to, you know, drink some coffee. They put the cards on the table, and lo and behold, they're one of the world's largest oil producers. And you give them 6 months, and you could turn the economy around. And at the moment, the dynamics of the debt is that the debt is there's a huge incentive to keep the debt current insofar as that's possible. So, you know, the real problems in Venezuela are political, and I think there is an expectation that at some point there will be a regime change, and then you can actually change the situation very rapidly. So if I was looking at, you know, the macro risk there today, to answer your question, I'd be looking at, I'd have to look at quite detailed level of support levels in the army and things like that. And a lot of that information is not easily available, certainly not to an outside investor today. So it's quite a difficult one to get the timing.
Okay, you mentioned participants' questions coming in, and we do want to keep this as interactive as possible. So while Jerome's talking, if there's other points that occur to you, please do just toggle to the bottom of your screen and you'll be able to pose a question. But one we've got in from Dimitra Defotis, who is Senior Editor for Emerging Markets from Barron's, is really to give some examples of, you know, maybe an example that stands out where you made some returns on one that you got well, and maybe an example of one that didn't go quite so well in your past.
Well, okay, why not stick with Venezuela? Because we made a lot of money in Venezuela years ago. There was a colleague of mine from the days when I worked in Washington who became finance minister. And I used to have conversations every couple of weeks. And at one point, she said she was going to create this Venezuelan program. And the point of the story here is the not invented here syndrome. So this was a period of Venezuela's history when, you know, to do a deal with the IMF was you know, signing your own political death warrant. But, you know, Maritza Seguera, that was her name, had worked for decades in Washington, very competent economist, worked on lots of different countries. She knew exactly how to structure a proper program. And she structured it because, you know, and sitting where she was in the cabinet, you know, that was therefore, it was called Agenda Venezuela. It was a Venezuelan program. So having some information about that and that it was coming out was you know, the piece of information that was very beneficial. And what was interesting about it was that not only when it came out did the Venezuelans love it, because here was a homegrown reform package, but an IMF spokesman at the time let it be known on one of the media channels that, well, if there'd been an IMF program, it would probably looked exactly the same. So the investors got the message as well. So there are moments like that when, you know, just get, you know, understanding and helping. And you know, in my time, you know, during the 90s and the noughties, talking to, you know, there were different phases. There were times early on where just knowing what was going to happen was important in the country. And then there were times when it was understanding, you know, the motives of people in Washington. Then it was, you know, it moved on again to understanding the structure of the market. And I write about that a lot in my book, that, you know, how actually knowing where pools of capital are. And what's always fascinated me is how different investor groups have different views of the world, and that affects their view of risk. It certainly affects their behavior when things go wrong. And it's what leads me to my ideas about the composition of the investor base being crucial to understanding systemic risk. If you get a homogenous investor base, you know, as people who have a different view exit gradually, and you end up, what is left is a group of people who believe an old model of the world, and when they then have their eureka moment, they all leave. So there is the structure, all these phases go through. But one of the interesting things when going back, if you like, to the 90s period was, you know, when you're trying to work out what information you want, the important thing is to be helpful. And, you know, there was this period, you know, when people would come down from Wall Street and barge into Buenos Aires, into an office or whatever, and they just, you know, fire off questions. And that may seem to be an obvious investor approach, but I always found that, you know, listening and answering questions was a much more productive way, because then you're providing something useful to whoever you're talking to, be it their policymaker. And then you listen to what questions they're asking. So if someone's asking you a question about, well, what do you think about the structure of the banking industry, and should, you know, banks be able to, you know, lay off risk when they sponsor a new issue? You know, these are telling you what the sort of reform issues they're coping with, and you only get that when you've built up trust. So, you know, this isn't about just information; it's about a two-way dialogue, and that's, I think, how you build up a network of contacts which helps you understand macro risk. And that's, you know, a lot of sort of my past history. What I'm doing now is much more sort of private markets, which is a different sort of skill set.
I want to go on to that in just a few minutes, but your book is all about the distorted sense of risk. I listened to you speak a couple of weeks ago in South Africa, and you were talking about how emerging markets to you is markets where risk is priced in. There's risk everywhere. To what extent, though, is the understanding of monetary economics, of monetary policy, lacking in some areas of governance, and how to what extent does that throw you a curveball? You know, how much that distorts?
I mean, there are two questions. Risk, you're absolutely right. We can talk about that for 20 minutes. But the second question is, I think, very relevant, particularly when looking at the developed world at the moment, which is, you know, I went to a conference a couple of years ago, and the great and the good of international monetary economics, you know, managing directors, the IMF, past and present, etc., central bank governors were there. And I can't remember who exactly said it, but someone said, you know, our international monetary system is dysfunctional. And some other panelists said, no, we simply don't have one. You know, it's semantics to say that it doesn't work. We don't have one. And I think a lot of people find international monetary economics complicated and too difficult. And therefore it sort of gets ignored. And it gets ignored in the press, in the regular press and the financial press, not just between investors. But it's actually a really important area. And I mean, I wrote my last blog about this. The point is, there's a whole history of development of the monetary system, which I think is crucial to understand today's imbalances, monetary imbalances. When you have an understanding of why Germany in the 70s finally said yes to France's efforts to build a common currency, in terms of the imbalance caused post 1971 by the so-called Nixon shock, where then followed by this sort of destructive recessionary interest rate tightening by Volcker, and of course in Europe and everywhere else from 79-80. From that period, you had, if you like, a huge sucking in of capital into the US. And a huge recessionary forces being spread across the developed world. And it was the motive then of Germany to, if you like, create its own incoming sources from the rest of Europe. And I think that changed. When you see the creation of the common currency in these terms, you realize the thing was never sustainable. And it certainly wasn't sustainable when some of the other countries were brought into it. And so it's only natural that it's falling apart. And I think it's quite myopic not to. I mean, the policy making in Europe I find flabbergasting, because all the history is there, all the politics is there, it's all written about. We understand all the problems that have been caused historically by massive inter-country indebtedness and relentless incapacity to forgive debt between countries, causing huge resentment, causing political reactions, which are very, very unpleasant. And I'm afraid to say that the common currency in Europe is becoming, it's dividing countries. And I think it's become a destructive power, and I think you can understand that very clearly if you just go back to the basic economics, the optimal currency zones we've known about for decades. Nothing's new here, but for some reason the political will to believe something else has overridden our rational selves, and it's politically incorrect in certain circumstances to say this. We're sitting in Britain. It's slightly easier here, but I think it's that's one example. And then there's the bigger picture of the imbalances between the developed and the developing world. It's almost de rigueur that if you have a newspaper article about China, the sub-editor has to write a negative headline. It doesn't matter what the story is. And I'm fed up with it. You can read a perfectly rational piece by a journalist, and yet the sub-editor will put in some terribly negative heading, because we need a bogeyman. We need to believe somehow that risk is a linear thing, and that however risky, the politics in the United States are, or the monetary chaos in Europe is, somehow, always and forever, emerging markets, by definition, has to be riskier. And this is a, complete nonsense. As William Booth said of something very similar, he said, you have to have a postgraduate degree in economics from an Anglo-Saxon university, to believe this, or not to see that it's perfectly obviously not true. And we have this bizarre idea that risk is some sort of linear scale.
Okay,
and,
let's pick up on risk in the US, because again, in your speech a couple of weeks ago, you turned to the subject of what everyone's talking about Donald Trump. What does Donald Trump mean for emerging markets from where you're sitting right now?
Well, I think it's could mean any number of things, and I don't have a crystal ball, and I'm not sure that the president himself is very clear about what's going to happen, and that's no bad thing. But there are lots and lots of things going on. I think in one sense, I remember this is a couple of years ago when the Trump candidacy was a mere sort of, it was there, but it wasn't taken that seriously. I was in a conference in somewhere in the East Coast in the States, and someone said of a Chinese academic who was giving the lecture, what do you think of a Trump presidency? And the very diplomatic answer was, well, if you believe in a zero-sum game, then of course it's very good for China. But we don't believe in a zero-sum game, and therefore it's it's going to be very challenging. And I think it does shake things up. I'm talking here specifically about the foreign policy, but the domestic policy is probably more important, so we'll talk about that in a moment maybe. But I think from a foreign policy point of view, there are going to be challenges for a lot of emerging markets, but opportunities too. And I think if we do get away from, if you like, the world of Westphalia, the idea power of realpolitik, of the sort of politics which has led to confrontation again and again to a sort of new Cold War. If we can get rid of that and realize that commerce and trade is a positive sum game, and we should be thinking less of our traditional diplomatic skills and more about commerce and engaging with countries as a way to resolve problems. Not all problems, some problems require a very clear position of force. But I think we've got a little bit simplistic in the way we look at the world sometimes, and we're a little bit hackneyed. So a bit of fresh thinking coming from a president for which everything is a fresh piece of paper is not all bad. Having said that, I'm still worried, as we all are, about certain things without getting into detail. I think the really interesting thing, though, on domestic policy is, ostensibly Plan A is to have a big fiscal stimulus, and through that stimulus have growth. And because of the size of the public and private sectors in the United States, apart from anything else, plus also what we know about multipliers, frankly, for growth really to occur, it's an absolute necessity that corporate investment picks up massively from where it is. Mm-hmm. Now, to understand why it's so low, we have to then go back to 08 and understand that for many companies in the US, they have been faced with huge uncertainty about possible depression and conditions. We've had a big volatility in growth numbers quarter by quarter, and I explain a lot of that with a huge inventory cycle in the US, and it's still happening. You get next to zero growth, and then a couple of quarters later it's 3-4%, and people by depending on how far they go back, where their baseline is, they draw completely opposite conclusions from the same data. And this is not a very serious, rigorous exercise. But what is happening is a big volatility through the inventory cycle. And also, that is telling you a little bit about the uncertainty facing the investment decision of firms. And I think there's a lot of evidence to say that capital investment by firms has not occurred. That has been stopped to a large extent. And to substitute that, they've hired lots of part-time and cheap labor. There are a lot of people in the United States who are massively overqualified for their jobs, and just in the last May, over 600,000 people just came out of the job market. So when we talk about unemployment being less of a problem, it depends on the denominator. I mean, if you put back some of those numbers and some of the arithmetic, some of the maths that goes into the computation of the unemployment rate is highly dubious anyway. You're actually looking at a country with a declining participation rate, 62% or so. Something like that off the top of my head. That means the other 37% of the working age population are not in gainful employment. Well, that's a huge number. Okay. And that's not captured in those numbers. You have 42 million people still on food stamps, and over half the country couldn't write a $500 check in an emergency. So, you know, the idea that, you know, the economy is suddenly recovering, no, it isn't. I mean, Trump got elected because he appealed to that voter. And the question is he going to deliver? And I'm very worried that corporate America, who is much closer to that reality, and to a certain extent by hiring cheap labor, has sort of helped the authorities create the myth that the employment figures are better than they are. Anyway, it's all set up for disappointment. Now, when it disappoints and we don't get that growth, but we still have a fiscal expansion, there is a scenario where, of course, that fiscal indiscipline, if you like, eventually spooks the bond markets and we get a bond crash, certainly a much steeper yield curve. At the moment, there's no inflation priced in for, you know, decades. Donald Trump has almost signaled what he's going to do. This is scenario B thinking now, which is borrow as much money as you possibly can. And then, you know, countries don't default when they print, you know, in their own currency, but you default by other means through inflation and devaluation. And if that happens, you know, he's borrowed as much as he possibly can, he's spent the money, he's not effectively repaying it in real terms to creditors, many of whom are international creditors. You know, who's the bigger fall? A big devaluation could get him re-elected because it really could create jobs through the export industries becoming much more competitive again. And then, of course, he'd be standing up and telling the markets, I'm really smart. In fact, I'm much smarter than you guys on Wall Street because I told you I was going to default by other means, and I've done it. And people have got jobs, and you know, the sucker capitalists that bought my bonds, well, you know, they can. You know, they can lump it.
Not too worried. Yeah.
And I suppose the most irritating thing for markets is he'll be absolutely right. He will have been smarter than them. Yeah. And what is amazing is the extent to which this sort of sense of disbelief about the US economy and the willingness to buy into the idea that US treasuries are somehow risk-free, which is an abuse of the English language. You know, that meme, that intellectual virus is still extraordinarily strong. And you know, that worked very well in the 70s. I don't think it's going to work. I think there's a real threat that it breaks. And when it breaks, it'll break because, and this comes back to our previous question, of international monetary imbalances. And you've got to realize that the largest international creditors in the world today are emerging market central banks. And it will be their decisions, led by China, which will decide, you know, how that story pans out. At the moment, China and other emerging market central banks have been very, very supportive. And they have prevented you know, huge disruption in international exchange markets and the huge consequences for savers as a result of that. And they've created that stability. But that chance has not been followed up anywhere, particularly with the needed structural reform. And you can only do that for so long. So I just think we're in a situation where there's huge risks still in the developed world.
So how do you deal with that as an emerging market investor? You're just starting
We
out.
invest more in emerging markets because the emerging markets is the part of the world which isn't.
And where in particular, where are you pushing? Because,
well,
you know, it's a relatively young company that you've created. Where
so
do you see as the biggest opportunity?
I can tell you what I am looking at. You know, I am looking a lot at India and Africa. And, you know, they are large populations. There's huge amounts to do. You know, I'm focusing very much on real estate and infrastructure, power generation, those sort of areas. And, you know, I want to continue the work, if you like, that we started at Ashmore, and Ashmore certainly is continuing, and it's a fantastic firm, you know, and, you know, hopefully I can, you know, work together with them. I don't know. But the point is, the next part of the task, and what I wrote about in my book, is to insofar as we've convinced institutional investors that emerging debt and local currency debt are proper asset classes, we now need to convince them also that private markets should be receiving much larger allocations, and they should be receiving these allocations not just because, you know, they add a bit of diversity or you get a bit of extra return for a bit of extra risk. No, people should be investing large amounts because they need to reduce risk. These are risk reducers, particularly in some of the very worst scenarios. Coming back to this concept of risk, most people care much more about large permanent loss than a bit of volatility. And we have this peculiar incentive problem that most people's capital is long-term, and most of the projects out there are long-term, but the people in the middle, the intermediaries, are often very short-term. And so all our advisors are always telling us, you know, volatility is really important, and, you know, being able to sell in an instant is really important. But actually, that's not that important. And if we can get ourselves out of that and step back and think about and trying, what I'm really trying to do is, in my book, is try to get people to take all that we know about macroeconomic imbalances and politics and anthropology and history and put that back into asset allocation. Asset allocation shouldn't be as simple as it appears to be. It's not just about numbers. It's certainly not about extrapolating from past volatility, of a few indices. That is not a prudent way to allocate in a world where you get events like 08.
And how do you allocate within emerging markets? You mentioned India, you mentioned Africa. Where's the biggest opportunity? Where do you? Well, how do you compare these places?
We get that question. You've probably been asked that question and asked that a lot of times. It's a classic question. What do you do now? The simple answer is, life is really not that simple, and you've got opportunities everywhere. And because risk is different for different people, it's not an absolute, it's not additive. Your risk is different to my risk for all sorts of reasons: liabilities, reaction speeds, institutional constraints, behavioral biases, but also information. So if I know more about a particular investment, fundamentally that can be less risky to me. So to answer your question, I would say, well, I've got to focus on some things. And what I'm trying to do with my asset management company now is really focus on specialist areas and get teams of people that really know things in depth, work in depth with partners. And that way I'm reducing risk and get in an early stage. So early stage development in power station generation, not just, wait for projects to come your way. Get involved in working out how to develop them in the first place, because that gives you deal flow. So I think it is about, I suppose, getting to the next layer of detail, not about where in geography or where sector-wise per se, but I happen to have been going to India since 1982, right? And I know India quite well. And it's a huge market. We've just, we've got with the Modi government, we've got great hopes, and we've got the GST, the general sales tax, which is going to be a huge opportunity. There are lots of things going. It's never a perfect story. Lots of challenges as well. And Africa, which has, if you like, it's coming so that many countries are still, you have to avoid, frankly. But a lot of countries are getting to a stage where, the policymakers are second generation, post independence, even third generation, and you have a institutional strength now, which enables, I think, the next level of investment to take place. You have rules on private investment. You have norms. You have behavior patterns which are changing and changing very rapidly. I
want to pick up on that, because one of the many questions we've had coming in, and I'm sorry we're not going to be able to get through all the questions, but we will follow up on Twitter on them, is all about the disruptive technology that we're seeing. And this question from Justin Wilmot of Sovereign Risk Insurance, who asks, how is blockchain going to affect emerging markets growth? Artificial intelligence, robotization, how do you see that impacting EM employment? And I must add that we've got about 2 minutes left.
Okay, well, I think very quickly, there are a number of different ways that it's going to impact. First of all, in terms of the ability to jump technologies, we've seen that ability, and the flexibility in emerging markets is much greater, where you have much more vested interest of labour forces and other interests in the developed world. So I think that's invigorating. Just like globalization for emerging markets is unambiguously good, but it's more nuanced and complicated in developed worlds. Secondly, blockchain is a great money saver, because it creates a massive increase in efficiency. And that's a good thing, and it's a good thing everywhere. But the third link here is the cryptocurrency thing. And here I think there is a danger. In an area of easy money, where QE is everybody's favorite friend, of course central banks are very happy with cryptocurrencies. But you've got to remember, just like the state has the monopoly on the legitimate use of force, so a central bank has the monopoly on the legitimate banning of all other currencies. And if they want to tighten, and at some point they will, I can easily see a scenario where Bitcoin and others are simply banned. They will simply be illegal.
And there'll be a regulatory reason for doing that.
Yes, because they want to tighten, they want to reduce the money supply. It's as simple as that. And it's convenient for central banks the world over at the minute to allow these currencies to exist. That may change.
Well, that's a good point to finish up. Thank everyone for really thought-provoking questions out there, and to extend our gratitude to Jerome for joining us on Frontiers Expert. Thank you.
Thank you.